Hi everyone, this is Vignesh from Investing Gurukul. So we have been talking about tech companies, tech IPOs in India. Is this actually a very big opportunity to make truckloads of money, or is this a bubble that has to be avoided? We spoke about the US tech companies, how they have performed, etc. in our first video of this series. So now let's look at the next thing. So we stopped at loss making. So most of these companies are making losses. Should we even buy? This is what we discussed in our last video. So this is a bubble. So half the people are saying this is a bubble waiting to burst. Don't buy. And then there are people who are saying even loss making company is fine. You can buy. So let's look at the US tech companies. First thing, they have been giving phenomenal returns. So Nasdaq has performed exceptionally well over the last 10 to 15 years. Most of these tech companies have been wealth created. There are a specific funds, ETFs, mutual funds that are available specifically focused on tech companies, and they have been wealth creators for people who have invested in this story. So, what are all the typical investment metrics we consider? So, when we invest in a company, in a stock, we look at whether it has strong profit margins, first point. And then we look at return ratios. Does the company have good ROE, ROCE, ROA, etc.? And we'll also check if the company has strong growth potential and if the company has been consistently growing. Then we'll also look at cash flows. So, does the company have proper free cash flow? Does the cash flow equate to net profits? So what is the key free cash flow to market cap ratio? So is this at a decent level where you can invest at a cheap valuation? So we'll also look at price to earnings ratio. So price versus EPS. So when you invest, we look at intrinsic value and we'll also check if there is a margin of safety that is available so that your capital is safe. So we'll also check if the company is consistently paying dividends. So these are some of the important metrics we look at when we invest in traditional companies. So what's the challenge in tech investing? So first thing we look at profitability. These companies are not profitable. They do not have any profit. So now how do we value them? Next thing, they do not have any cash flows either. So no cash flow, no profitability, no margin. So there is no way to calculate price to earnings, no way to calculate free cash flow to market cap ratio, no way to find out other return ratios like ROE, ROCE. None of them are possible. So even some companies are having a negative operating margin. Even some of them have EBITDA percentage in negative. So, which is another cause of concern. And they are in growth stage. They do not have profits. So, obviously, they cannot pay you dividends. Now, but still, US tech companies have been giving extraordinary returns over a decade. So, let's look at Indian companies. So, do these companies rally and end up as a bubble? Why are these companies going up? If they are really good, why are they not profitable? Why profitability is missing in these tech companies? So let's look at some US companies as an example. So this is an excerpt from Walmart. So they are saying focusing too early on that profit instead of growth and deleting customers is probably counterproductive. What they are saying is sales growth is very critical and important. We should not focus on profitability right now. So if they focus on improving their profits, the stock price may rise in the short term. But what happens is its market share could fall. It may lose a lot of customers. Its sales might decrease. So the Wall Street might not reward this company in the long term. That is the danger thing. Now let's look at some of the US listed companies, booking.com, and see if they are actually profitable. Do they have free cash flows? Because this is one question that's been asked with Indian tech companies. Let's look at actual data from these tech companies listed in the US. So all these data are from 2022 for information purpose. So Booking.com has a profitable business model. It has net profit, which is more than zero. It has positive free cash flow. And other companies in the travel booking space, none of them are profitable. Sabre, TripAdvisor. So when did they come up with an IPO? 99, 2014, 2011, 2005. And let's look at traditional marketplace companies like Etsy, Shutterstock, eBay. All of them are profitable. All of them have positive free cash flow. Let's look at lending companies. So a couple of companies have profitability, but only one of them is having positive free cash flow. And then let's look at other traditional marketplaces like Upwork, Fiverr, Airbnb. None of them are making any money. All of them got listed between 2018 and 2021. Poshmark. All of them are famous companies that have been doing well, and even we know all these companies by their names. So let's look at some more data. So let's look at labor intensive platform again. Companies came up with an IPO between 2011 and 2020. And the company that came up with IPO in 2011 was Groupon. It is profitable. It has positive EBITDA margin, but the cash flows are negative. Well, all other companies, 2017, 2020, 2021, not the year. So Redfin, Open Door, Compass, all of them have negative margins. So this is in the year 2021. All these numbers are from. DraftKings is again negative. Meal delivery companies, Grub, Waiter, DoorDash. So this is similar to our Swiggy and Zomato and Uber Eats. Uber Eats is not available anymore. So all of them are not profitable. Only Waiter, which came in 2016, is having a positive EBITDA margin and a positive free cash flow. Companies that came up with an IPO in 2020, all of them have negative numbers. Now let's look at ride-sharing apps like Uber, Lyft, which is similar to our Ola and Uber. 2019 IPO, none of them are profitable. No one has any free cash flow. Let's look at subscription revenues. Companies like Netflix, Zillow, Bumble, March Group, and all of them are doing really well. Most of them are profitable. All of them have an EBITDA positive margin and a free cash flow is positive as well. So all of them have, except Bumble, all of them came up with an IPO a long back. Bumble is doing really well. One of the very few companies to come up with an IPO recently and still have profitability in all the numbers. So now let's look at e-commerce. So in the e-commerce space, pet. So again, let's look at the same thing. 2021, 2020, 2019 IPOs, all of them are not profitable. Companies that came up with IPOs long back in 99, 2002, 2007, 2013, 2019, all of them are profitable. So some of them that have been in the market for a long period of time are profitable, whereas companies that came up with an IPO recently are not doing that well in terms of profitability, margins, and cash flows. So let's look at more e-commerce companies, same case. So companies that came up with an IPO in 2017, Stitch Fix, Caravana, Blue Apron, all of them have negative numbers. Amazon till 2011 or 12, it was not making any money. It was not profitable. Only after AWS came into the picture, they started showing profitability. Till then, it was not a profitable company. People who keep asking questions, Zomato is not making any money. It is not profitable. Paytm is not profitable. Nykaa is not profitable. All of them have an answer from a company like Amazon, who struggled for more than 13 to 15 years from its IPO with no profits. Only after 15 years, they started showing profitability. That too because of an in-house product called AWS, which was built to solve their own internal needs, which was later packaged and sold to external companies, which created a cloud infrastructure as a new product category. So, if not for AWS, they might have taken some more time to become profitable with just e-commerce. So, payment companies like Square, PayPal, they are all doing really well. All of them are profitable. So, what do we infer from this data? So this is what we can infer from this data. So niche players and leaders tend to do really well. So as I showed in that number, company like Netflix is doing exceptionally well, and then niche players like payment companies are doing really well. So it takes 1 to 3 years to become EBITDA positive for 75% of the companies. So if a company is coming up with an IPO now, you should give them at least 3 years of time to become EBITDA positive, not net profit positive. Just to achieve operating margins positivity, you have to give them 3 years of time. So that is how tech companies have been evolving in US. That's how it has been listed. That's how it has been giving phenomenal rewards for customers. Now, if you look at the data further, if you go deeper, 45% companies take 3 to 5 years to become profitable. So if you invest in these companies, Zomato came up with an IPO in 2021. So over 4 years, they have been trying to achieve profitability. They are slightly profitable now. In the next 1 to 2 years, companies like Policy Bazaar, Zomato should become profitable. So you should basically focus on this 45%. So if a company has come up with an IPO and it has become profitable in 3 to 5 years after IPO, then you can consider investing in that company. So focus on this 45% companies that can actually do well. So let's look at more data. So it was profitability by the third year that really mattered. If you look at all those data points. So since 2020, IPOs with positive net income by year three have seen positive excess returns and the highest likelihood of outperformance. So check out all these companies: Paytm, Zomato, Policy Bazaar, Nika, Ixigo. Just check their numbers. If they're able to become profitable over 3 to 5 years, especially if they become EBITDA profitable by the end of year three, then you can think about investing in them. They have a higher likelihood of giving you exceptional returns. And companies always have a path towards profitability. And cash flows continue to remain important even if the companies are not profitable. Check if the companies have positive free cash flows after 3 to 5 years. So there are some opportunities where there is not a lot of play left. There is a lot of opportunity. If the opportunity size is actually huge, companies will continue to invest more money on R&D, sales, and marketing to get more customers, to get more market share, and generate more revenues. So because of which, these companies will continue to remain loss-making companies. But what you have to look at is something we'll discuss more in detail in the next part of this video. So as long as the market is huge, the opportunity for Zomato is just very huge. With companies trying to capture market share, companies may not become profitable. Whenever there is a saturation in growth, the focus will shift towards profitability. So if sales growth is declining and if there is no profitability, then those companies may not be good opportunities to invest. So let's talk about the valuation. So these companies are not profitable, but still why they are valued very highly. So we'll discuss this in our next video of the series. If you like this video, subscribe to our channel. You can share this with your friends as well. If you have any questions, post it on the comment section. Meet you soon in the next video of this series. Bye.